Today we're going to continue our 3-module unit on valuation models, and we're going to do right now talk about different equity valuation models and the information that's needed to compute them. And this is all part of module 13, cash flow based valuation. So the reason why this is so important, this may be the most important thing that you ever learn in accounting, believe it or not, because you may be wondering, if I'm not going to be a financial analyst, what's the point of all of this? Or if I'm not an accountant, what's the point of all of this? And obviously, if you want to be a financial analyst, then you need to understand valuation. It's a key topic for financial analysis. Maybe the accountant might not seem so important to you. The accounting is very important. But the reason why these 3 chapters, and especially this chapter in particular, is so important, because these chapters explain to you why accounting information is relevant to valuation. And you're probably saying to yourself, why should I care why accounting information is relevant to valuation? Because this is why accounting is important. This is how investors use accounting information to determine the value of the stock. And if you can determine the value of the stock, then you can make a smart investment choice and make money. And this is how markets work. Markets work where investors and analysts try to estimate what the value of a stock is. That's a very difficult thing to do. But a key piece of information for doing that is the accounting information, your forecast. And what are your forecasts based on? Nothing but accounting. That's how you did your forecast. So what we're going to talk about right now is we're going to explain to you why accounting information is relevant to the valuation decision. And the valuation decision, valuation itself, is key to making investment choices. And investment choices is what makes markets work. It's what makes the entire financial market function. So this chapter, I can't underestimate how important this chapter is. If I had a choice, every accounting student would have to take this course, and I would spend a lot of time on the last chapter and this chapter and this whole operating income model that we've been talking about all term long. So let's talk about the different models that we've been looking at. The primary model we've been talking about so far is the dividend discount model. That was in module 12. And what we say is that when you make an investment, the returns you're expecting on that investment come in terms of dividends, a series of dividends, and then when you eventually sell off your stock, it's the value of the stock when you sell it. And that is, if you take the present value of all that information, then that's your estimated value of the stock. If the actual value on the market is higher, then it's a good deal. The actual value on the stock market is lower, then it's a bad deal. So the expected future stock price is assumed to be related to be expected dividends that will come later on. So the dividend discount model itself feeds kind of on itself, because whatever you sell the stock for, that's going to be based on the value of the dividends after that, and so on and so forth. The problem with this dividend discount model is, and that the primary problem is that a lot of companies don't pay dividends. So good luck. The other problem with it is that it's heavily reliant on a future stock price, and it's very difficult to anticipate, to predict future stock prices. Another model is called the discount cash flow model. And what we try to do here is, instead of looking at dividends, because not all companies have dividends, we look at free cash flow. And research has shown that free cash flow bears a very strong relationship to dividends. Because in essence, what free cash flow is, it's a cash flow that's put off by the business after you pay for capital improvements. And these capital improvements, by the way, would only be to replace the existing capital infrastructure, not to acquire new property, plant, and equipment that would expand your business. So in essence, it's cash flows from operations, net cash flows from operations, minus capital expenditures. I shouldn't really use the term capital improvements. I should use the term capital expenditures. That's buying PP&E and land in order to keep your business going the way it is, not to expand. So the discounted cash flow model estimates the value of the company as present value of expected future free cash flow from the firm. And then that's the total value of the firm. You would subtract the intrinsic value of the debt in order to get the intrinsic value of the stock. And that's how the discounted cash flow model works. So far we've covered really three different models. We had the dividend discount model, two models, dividend discount model, and now we're talking about the discounted cash flow model. Finally, I want to talk about the ROPI model, residual operating income model. And now the ROPI model is very new. It's about, they were researching it and designed it when I was in grad school in the 1990s. So this is, in accounting terms, it's about 20 years old. So it's relatively new. People were just starting to experiment with it in. And it seems like a more reliable model and a more useful model than the discounted cash flow model or the dividend discount model. And this focuses on return on net operating assets and the combination of net operating profit margin and net operating asset turnover. And it has been shown in research that this is more closely related to stock value than dividends or discounted cash flows based on free cash flow. So the ROPI model is a good model. It's a little more complicated to do, but it's more reliable. And more reliable means that if you use it, you're likely to get a better estimate of the real value of the business, and therefore you're making a smarter investment. So again, all these models mathematically, it has been shown they're pretty much the same. But because they use different inputs, those inputs may or may not be more closely related to returns than others. But it's been shown that they all equate to market value in one way or another. There are different ways to get at the same answer. Some ways are better than others depending on the information that you have. Because we function in a world of limited information, we don't really know what future dividends are going to be. We don't know what future profitability is going to be. When you worked on your projection, you were probably wondering, gee, this can't be accurate at all. You know what? You could do this for 20 years and you're still not going to think your projections are accurate because there's no way of predicting the future. So they all come from the same model. And again, there's 4 steps that we've been talking about. It's always useful to go back to these 4 steps. You got to understand your business environment and the accounting information that you're given. You go into your sandbox, you play around with the information a little bit in order to get more reliable measures than what the accounting gives you. Sometimes accounting is a little misleading, so play around with it a little bit to get something that's less misleading. Then you do your forecast. That was module 11. It's a key step, and it's very difficult, and it's difficult to come up with numbers that you feel are reliable. And then you determine the valuation. And so what we're talking about now is we're going to talk about cash flow based valuation. And then in the following module, in module 14, we're going to talk about the ROPI model. So in the next video, we'll talk more about discounted free cash flow.